Welcome everyone to the Future of Real Estate podcast. This is your host, Ellis, Hammond, and one of the biggest questions in the capital markets as an investor you might be having is, where do I find yield for my investor dollars? Massive question. A lot of people are chasing yield in this low cap rate environment. And our guest today, Mr. Sam Wilson, CEO and founder of Bricken Investment Group, makes a very, very strong case for RV park investing. Now, we've already seen Sam Zell, who can be credited as one of the founders of the modern day REIT. He also was a big investor in manufactured housing, mobile home parks before institutional money started flooding into that asset class, and we've seen where that has gone. They have also made a massive investment into RV parks. Also because of COVID and many other factors, RV sales are through the roof over the last 2 years. And so our guest today is going to talk about why he sees RV parks as the next frontier in terms of real estate investing and what him and his company are doing to leverage this asset, the value add plays, how they're using tech on a more traditional asset class like RV parks. I think you're going to really enjoy this show as an active or a passive investor. Let's get into the show. Sam, welcome to the Future Real Estate Show. What's up, man?
Hey, Ellis. Thanks for having me.
Dude, let's get into this. I am so looking forward to talking about RV parks and the future of, because this kind of encapsulates a lot of things. Short-term rentals, is there. I love a good business model where it's kind of an older industry, kind of primed for new technology, and that's essentially what you're doing. Correct me if I'm wrong there, but kind of tell me a little bit about kind of how you got into this. And I want to get into where this industry is really heading.
Yeah, opportunity is, I think that's every entrepreneur's problem, is that we always see opportunity, right?
Yeah.
As we were talking about before we started this, my goal is to find things in my life to say no to, because there's always another good idea. But this one came across my desk about a year and a half ago. Somebody called me and said, "Hey, I want to build a boat and RV storage facility. And I don't know how to do it, but I've got the right land to do it." I said, "Okay, that's a really cool project. Let me take a look at it." And long story short, we ended up mostly building a boat and RV storage facility. I say mostly because we were actually bought out once we got the land scraped, electricity run to it, signs on the highway, and then next thing you know, somebody's like, "Hey, I want to buy your project," which is great. So I never actually built the facility. But in so doing, in getting to that step, we obviously had all our suppliers, had all our builders, everybody lined up. But I had to do an enormous amount of industry research. And when I started doing that research, I was just kind of clued into the idea that, oh my gosh, there is so much potential in this industry for, like you said, it's a fragmented industry. There's so much mom and pop, or so many mom and pop owners. There's so much legacy, running off of old software. There's just an enormous amount of opportunity to bring an institutional approach to ownership and management. You just don't see in the space. Not to mention, so you got your supply side problems, which are also exacerbated by the demand side, which is that we've had, 600,000 some odd RV deliveries in 2021, which was almost in 2020 we had 350,000 some odd RV deliveries. So like a 40% increase in deliveries year over year, which is just crazy for new stock coming online. So now you got all these RVs with families now. Your largest demographic of owners is between 35 and 55 now with kids. So now it's families in RVs, not, your grandparents driving around the country taking a national park tour. So Now you got all these families looking for a place to go, and all you have are these old legacy RV parks. There's just huge opportunity for us to bring a lot of new technology to the space and really turn it.
Well, that's really interesting, right? Because I think about, if you are really attracting young families, typically these are going to be folks who are, if they're able to buy an RV and travel across the country with their family, and especially be able to take off work, they're probably not poor families, meaning they're probably used to a style of life and access to technology and accommodations. And so that's why I don't like camping, just to be honest with you, man. Like I want to go and I want to be able to have modern technology and a nice glass of wine and somewhere to kind of, heat my stuff. So I think that makes a ton of sense, man. And that's more of the folks who are kind of beginning to adopt this space.
Right. Very much so. I think in years past, it Well, even in years past, you had some really nice RV parks, but you just didn't have this younger demographic using them to the extent that they are now. I mean, a lot of this has been pandemic driven. I randomly bought an RV in 2019 just by chance. I never planned on buying one. I bought one, and my wife and I would never get rid of one. It's like, oh my gosh, once we started traveling in it with kids, we're like, this is the best thing ever. Like, just never going anywhere, not in the RV if it's out of the city, which is hysterical. But yeah, you're absolutely right. It is the middle class that is using it, but it's once you own the asset, once you own the RV, I mean, it's a relatively economical way to get around though too. You're going to take the whole family on a 7 or 10 day trip, flights, hotels, all that stuff, even Airbnbs are going to cost you 3 times that much as it would to go, hey, take the kids to a fun, and what we want to buy is more the RV. I don't want to own a park. I want to own RV resort style, where you've got swimming pools, you got stuff to do. There's a lot more going on there than just, hey, go park on a roadside RV park. So anyway, I'm wandering all over the place there on you.
So let me ask you this. So one of the books I've been reading recently is a book, Sam Zell's autobiography. He was one of the first guys who kind of spotlighted or began to bring institutional capital into manufactured homes, mobile home parks.
Mm-hmm.
And so I'm just curious if you see a correlation between, one is how much institutional capital is currently in this space, if any at all, and just the correlations of kind of those early days of manufactured homes, mobile home parks to what it is today, and the same thing with RV. Maybe you can speak to that and kind of enlighten me, because I truly do not know.
You're right. There is some institutional capital in there, right? It's not, the institutional capital has their hands in almost everything, but not nearly to the degree of they do in mobile home parks. That said, we're trading, this is my own kind of theory on it, is that we're 5 years behind where mobile home parks have been. So we're right now where you could buy a mobile home park 5 years ago. I mean, what are mobile home parks on a national average trading in the 6, maybe high 5s on a cap rate basis? I mean, on a national average right now in the RV park space, you're looking at about an 8.75% cap rate. I mean, a dramatic difference in just pricing alone. Now, with that, of course, there's a lot more operational complexities in an RV park. But hey, with that comes more exaggerated returns. So yeah, I think we are at the front end of where mobile home parks were 5 years ago.
Explain your difference there, and I thought that was really interesting. So you say, I don't want to just buy parks, I want to buy resort-style stuff. I mean, explain, I understand the thesis there. You want to have access to amenities and whatnot. So dive into that a little bit for me, and then, again, like, are those mom and pop run today? I mean, is there still a way, an opportunity to go and implement tech and packages and things like that? I mean, explain kind of your typical profile of a current owner of that and the opportunity to go buy those type of assets.
Yeah, so it is mom and pop owned, and I don't remember the other part of your question, but
it's so the current profile of that type of owner still is non-sophisticated. I mean, I'm not gonna say they're sophisticated, but I mean, right, they're single owner, double asset owner, maybe.
Yeah, right. They own typically one asset. That's okay. They're like, hey, we're going to run this for 10 years. We're going to do what we can, but they haven't thought about, like, here's a prime example. Looking at a park right now that more than likely will get under contract. Here's the one thing that the owner said. He said, well, and mind you, they're 100% booked for the entire summer season. He said, I've got to do my capital improvement projects one at a time. I promised myself I wouldn't take on more than one. Yeah, we're 100% booked. And yes, I have more land to build more RV sites, but we're not going to do that until I'm done with Project X, whatever it was. Project X may or may not be income producing, right? I'm sitting here going, timeout. You're booked for the whole season and you're not building more spaces. Why? Like, you've got a waiting list and you're going to go do a project. And that's just the type of thinking that goes on in these, because they've got limited bandwidth, right?
Right.
And I get it. It's like, well, we're tired. Like, we're going to do the projects we can do, and what we don't do, we don't do. Oh, well. Whereas if you bring an institutional approach to it, where it's like, all right, look, or a sophisticated approach, it's like, yeah, we're raising the money, we're doing every capital improvement project that yields greater income that we can do as fast as we can do them. Like, that just makes sense. One of the things that we're going to implement is dynamic pricing. Most of your mom and pop owners don't have a dynamic pricing system in place, where you have, the greater the demand, the higher the price goes, similar to the airlines or to
Yeah,
Airbnb,
Airbnb, right? Yeah, you can do dynamic pricing on Airbnb. So, Sam,
100%.
what's the lending on this? What's the lending environment right now for RV parks?
Sub 10 million local lenders typically. I mean, you're gonna get a little higher rate, but that's okay. The returns on these are exceptional. I mean, that's the other really great part about it is that your cash on cash returns are in your mid to high teens. Your average annual return is going to be in your mid 20s. I mean, it's a really attractive
So
place.
you're saying local, so local banks. I mean, is there any agency or any? So are you getting like a bridge type product, or what does this look like?
Yeah, you mean on term?
Yeah, on terms.
Yeah, you're going to get a 20-year term, rate somewhere in the probably low fives. And again, I don't know what it's going to look like here after this week, but a 20-year term and whatever your AM schedule would be, when that comes due, I don't know, but yeah, you'd have a 20-year term. Again, I don't know what your agency debt looks like because we haven't gone there yet. I mean, it's not our
Right.
plan.
Right.
We're anything we're buying right now is in that sub 10 million range, and once we get above that, because what we want to really do is buy several parks that are in that 5 to 8 million range, really get our feet wet, understand exactly what we're doing, get our systems dialed in, and then go bigger.
Yeah. And so your goal, I'm guessing, is to recapitalize those deals or maybe look to sell those deals. So you're able to get some type of lending or financing. Well, they'll kind of give you flexibility in your loan terms, is what I'm hearing. I mean, do you want to be able to refinance that deal after 2 or 3 years to be able to sell that deal, or are you locked into that loan for, as you say, 20 years?
Yeah, you'd probably be more locked in. Now, when if it's a balloon, I don't know that you'd have 20 years to pay it off. There may be a 5 or 8 or 10 year balloon on that.
Mm-hmm.
What that looks like, but at this point, no, I wouldn't foresee refinancing that to be anything that we're underwriting at this point.
And then in terms of tech, I mean, tell me your value add models on these deals.
I mean, Wi-Fi, that's your fourth utility, right? It's like how many of these parks don't have Wi-Fi? Like
Huh.
everybody wants Wi-Fi, right? I mean, that's a simple, hey man, it's $5 if you're a transient for somebody just coming in and staying for the weekend. All right, it's $5 or $8 a day like the hotels do, right? That's a great add-on. Or if you're along, which we haven't talked about long-term tenants at RV parks, it functions a lot like mobile home parks. But your long-term tenants, it might be, $80 a month to sign up for Wi-Fi. I mean, that's a really easy value add play. Dynamic pricing is what we've seen is that when we underwrite this with a dynamic pricing model, we can add 10% to the bottom line just by adding dynamic pricing. Like that's
Yeah.
just, I mean, how many of these people have had the same rates for the same years? Like, well, it's $70 a night. It's $70 a night on July 4th. Really? Like, you mean 270, right? Like, it just stuff like that. Those are enormous value adds. Of course, on parks where they haven't built out the extra sites, where they've got untapped potential there, or you've got land that's not used. Not to mention storage. That's the other part of it. Is if we have excess land, boat and RV storage is a great companion to that product. It's like, well, you know what? If you're not parking your RV in a site and you want to store it for the winter, you need boat and RV storage. It's a very, very simple extra add-on that really drive revenue up.
That's huge. And then your investors on this deal, I mean, typically are you kind of the syndication approach where you're working with sophisticated accredited investors, average investment amount of, 6 figures.
Yes, and that's well, yeah, and right now we've been at 50, which I think everybody's been at 50 for a long time. One of the things I'll be honest, and I'm working my way through this. One of the things I haven't liked about the syndication model, and I've done plenty of them, been a part of plenty of them, both as a passive and an active investor. I haven't liked the fact that when I get money back, I then have to go out and find a new deal, right? It's like, oh, okay. And not that my model solves this in its own right, but one of the things, and the other thing I haven't liked on the active side is that then we're kind of forced to exit. I want to find a way to return everybody's capital via cash flow. And like you said, maybe we can underwrite, a refi in 3 or 5 years down the road. I don't know. But even if we were able to do that, I want to hold deals indefinitely. I know the idea is that you sell them so you can reap that equity and then go out and start the process over, do your value add play, reap the equity, and just keep, wash, rinse, repeat. But I've kind of got this long-term dream of owning a whole bunch of assets and never being forced to sell them. So working our way through what that could look like, I haven't really been able to figure out that part of part of the equation yet where everybody gets their money back and we keep making
Yeah.
money, but we're working our way
Any
through it.
any bold, I mean, since you've studied this, I mean, any bold predictions in this space? I mean, you talked about we're 5 years behind mobile home parks. There's a little bit of institutional capital coming into this. I mean, I don't know. In terms of what we haven't talked about already, any bold predictions about the future of kind of where you see RV investing going?
Yeah, I mean, I think as these assets get gobbled up, as they become more sophisticated in the way they are run, we saw this. I mean, you've seen this in multifamily, you've seen this in mobile home, you've seen it in every asset class. That as the pool of buyers gets more sophisticated, as they become easier to run, as the packages get packaged up, you get 10, 20 of these assets, then suddenly you've got a $100 or $2 million portfolio that an institutional partner come in and buy and cash you out. And so once I think that starts happening, then yes, the cap rates will compress just like everything else. People are chasing yield. And if you can find outstanding yield with a proven model, I mean the prices on that are just going to go up.
Yeah, I think it's a great word. And is that kind of Bricken investment groups that's your focus? I know we talked a little bit about. We're not going to get into the day laundry mats. I told you that's a beer conversation right there.
Right.
But I mean, this is a core focus for you guys.
100%. It's RV parks is the primary focus, with RV and boat storage as a secondary to that. And those two are going to go together, I think, very nicely. Again, when you're buying and we're looking at several of the facilities we're looking at right now have that as a secondary component, where it's like, oh, we can build this out right here on the extra acreage. So,
Well, let me ask you a last question on this in terms of market. I mean, do you prefer a more secondary or tertiary market? Like, do you need to be close to a larger MSA city? I mean, in terms of kind of criteria there, what have you found to be really important in terms from a market dynamic standpoint?
Less than 2 hours from a major city. A couple of reasons for that, and or very close to an attraction. Say like here in Tennessee, you'd want to be anywhere near the Smokies is a great place to be, right? But with that, also you're within 2 hours of several major cities. The reasons for that are a couple, and the reasons we don't want to buy the roadside RV parks is, one, gas is already expensive, right? So this is a real concern and a real headwind for the RV park space. Is that if gas goes to $8 a gallon, people aren't going to drive their RVs across the country anymore. If you live in East Tennessee, you're not going, out to the Colorado mountains in your RV. You're going to spend $3,000 just in fuel getting there and back. I'm obviously exaggerating, maybe. But so that being said, being within a couple hours of a large MSA is, I think, really key.
Yeah,
so
that is.
And the other thing is that when you have these roadside, RV parks out in the middle of nowhere on the highways that cross the country, I just think those are a lot more. They're not very recession resistant. They're the last place that people stay because they need to, not because they want to. Mm-hmm. So we want to buy RV parks in places where people want to go, not need to go.
Makes sense. Yeah, a lot of sense. I love how you're kind of hedging against some of those things. Sam, man, where's the best place for folks to come and kind of learn about more of the RV investing, what you guys are doing with BIG?
Best thing to do would be join the Bricken Investor Club. Go to Bricken, Bricken, investmentgroup.com. Join our investor club. You'll get notified about all our deals, as well as get our weekly newsletter that just kind of tells you what we're up to.
Guys, love that. Super interested in RV parks. If so, make sure you head that. We'll post that link in the show notes below. And if you're enjoying if you're enjoying this content, if you enjoyed this episode, do us a favor. Help us continue to attract great guests like Sam. Leave us a 5-star written review and share this. Take a screenshot. Sam, you're on Twitter. You're on LinkedIn, right?
I'm everywhere, man.
Guys, go tag us over there too. Let us know you enjoyed this episode. We'll see you next week.